Welcome to Module 15, Market-Based Valuation. Today we're going to be talking a little bit about peer group multiples and what kind of inferences we can make when a group of your company's peers are trading at a certain multiple of profits or earnings as defined by a variety of different techniques, net operating profit after tax, so on and so forth. If your peer group is trading at a premium or a discount from where your target company is trading at, then we can glean information from that and use that information to calculate a comparable price for the company that we're doing our research project on. So let's take a look at some of the multiples that we're going to be looking at today and the models that take these into consideration. This is a very simplistic technique to valuation. So simplicity has its advantages in that it's quick and it can give us some powerful insights in a short amount of time. But it's also a swag. It's going to be less precise. It doesn't demand the rigor that we've been putting into these case studies for now going on 14, 15 weeks. So it's important that we keep that in mind and contextualize that a little bit. If we were relying on these models in and of themselves, we'd be deficient by any measure, but in conjunction with the rest of the work that we've been doing for the past 14 weeks, they can provide new insights. So there is some value here, and it's worth crunching the numbers on to get that perspective. When we look at comparable multiples, there's a couple of things to keep in mind. If the measure that we're focusing on is an equity performance measure, then the output will be an equity value. The examples that the authors give us here are earnings and book value. These are the most common price to earnings ratio. The price to earnings ratio is the most common ratio in probably all of finance. Price to book ratio would be a close second. Now at the bottom of the screen there, our authors tell us that if a company performance measure is selected, primary examples here being net operating profit after tax or net operating assets, then the output of our model will be a company value. Now that would be similar to the discounted cash flow. If we're valuing the entire company, then you can think of that as being similar to the enterprise value of the company. And if we end up with enterprise value, then we're going to have to subtract the debt and divide by shares outstanding to get a comparable to share price. And here's our formula. Step number one is to select the measure in question, whether that's earnings or book value or NOPAT or net operating assets. Step number two is to select our comparable companies, and you can get a list of comps from Morningstar, Yahoo, or Bloomberg. Hopefully you've already identified the relevant competitors from your case studies. That was all the way back in Module 2. Step number three, compute the market multiple from the comps. So if we're looking at, I think here in a minute we're going to look at the dollar store, if memory serves, in Module 15. You can compare the price of that company to its closest comps, say Family Dollar and another, and calculate where it should be trading if we were to base its valuation on its peer group multiples. Step number four, compute the target company's value based on those performance measures. And then lastly, recognize the difference between the firm value and the equity value. So if we need to make adjustments for non-operating liabilities and non-controlling interests, we can do that to get back at the equity value of the firm vis-a-vis the enterprise value of the firm. I talked a little bit about deficiencies or weaknesses of this model. It's great, it's easy, but because it's easy, it's also imprecise. There's no two companies that are exactly the same, and that's one of the implicit assumptions inside of these models, is that one company should be trading at the multiple of another company. Well, maybe, the second company usually has advantages that afford it a higher multiple on account of those advantages. So to say that the first company should be trading at the second company's multiple is is prone to all sorts of inaccuracies, and we just need to be aware of the very, very rough estimate kind of nature of these valuation models. Moving on to the first learning objective, explain company valuation using market multiples based on balance measures. And I think there the authors meant balance sheet measures. If we look at the balance sheet data for Dollar General here, these are taken from the market and from financial statements. So the authors are giving us Dollar General, Dollar Tree, and Big Lots as comparables. Dollar General, Dollar Tree probably much more comparable than Big Lots as a larger discount retailer. So we have to be aware that these aren't perfect comparables. Nevertheless, they're going to serve as good examples for multiple-based models to learn from. So first, let's take a look at the net operating asset multiple, the NOA, and we're looking at Dollar Tree here. So we have the company assumed value of $25 billion, the net operating assets of $11 billion for Dollar Tree, and common shares outstanding. Now our net operating asset market multiple for Dollar General 2.49, for Dollar Tree 2.34, and for Big Lots 2.63. So what we can do is take Dollar General and Big Lots at 2.34 and 2.63 and average those two to get 2.49. So Dollar Tree currently trades at 2.34. We know that its peer group or its closest comps trade at 2.49. What would Dollar Tree's value be if it traded in line with its peer group, meaning a net operating asset multiple of 2.49? That's the question at hand. If we go to the next slide here, we can see that calculation. We're going to take Dollar General's net operating assets times the market multiple of 2.49 to compute an equity intrinsic value, or an enterprise value, excuse me, of $20,396,000. Now, to get back at the equity value, we have to subtract off the net non-operating obligations. So we'll take the enterprise value of $20 billion, subtract net non-operating obligations of $2.8 billion to get an equity value of $17.5 billion. Dollar General's equity value of $17.5 billion divided by shares outstanding yields a share price of $61.33. Okay, now let's do the same thing for book value, recognizing at the start that book value is an equity-based component, an equity-based measurable, and therefore we won't have the final step that we just used with NOA, which was to subtract off the net non-operating obligations. So in this example, Dollar General has a book value market multiple of Big Lots 2.64, Dollar Tree 4.34. We're going to average both of those to come up with a 3.49 book value market multiple. And we have the equity intrinsic value equals the book value of equity times the book value market multiple. So the basic equation is the same. We're calculating the market multiple for two comparable firms and using that to forecast the valuation of a third firm. And in this instance, that average gives us an equity value of $18 billion. Divide that by shares outstanding to compute a share forecast of $65.46. And then our authors note that because Dollar General's actual stock price at the year end was $75, its stock price is markedly overvalued. Again, that's simplistic because Dollar General may have a better geographic footprint, it may have better margins, it may have better growth prospects. All of those things would justify that higher stock price. But in this simplistic model, we're not taking into consideration any of that. So just be mindful. We can definitely gather information using these techniques, but we have to be mindful of what we're missing out on as well. And then our authors basically make that same point here on slide number 13, urging us to consider other factors such as profitability, growth, risk, same industry, capital structure, so on and so forth. Learning objective number 2, explain company valuation using market multiples based on income statement measures. So these are most common, and the most common of the income statement measures is price to earnings. Let's look at price to earnings, but first let's look at net operating profit after tax. Same 3 companies, Dollar General, Dollar Tree, Big Lots. Dollar General's intrinsic value equals the 1.22 billion times 25 for a total of 31 billion. Dollar General's equity intrinsic value per share equals the 31 billion minus the 2.8 non-operating obligations divided by shares outstanding equals 98.92. So the formula here is the same, regardless of whether or not we're looking at an income statement multiple, a balance sheet multiple. We're deriving the value of the comps and using those values to derive the value of the firm at hand. So in this instance, we can look at net income multiple. So same basic formula. We're going to take Dollar General's equity of 1.164 times market multiple of 40.6, which is the average of the 67 and the 13, divided by shares outstanding, equals 164.73. So moving on, I'm hopeful that sounds that's fairly intuitive to everybody. Learning objective number 3, identify comparable companies for use in company valuation with market multiples. Again, this should be fairly intuitive because, Morningstar is going to do that for us. Bloomberg's going to do that for us. Yahoo's going to do that for us. But we need to audit those comps that appear and make sure that they're roughly the same size, have the same level of profitability, are substantially similar on the in maturity, in their growth curve, growing at the same rates, have the same level of risk, and have, ballpark common price to book, price to earnings multiples. Because if they don't, then that's probably an indication that it's not a good comp. Or it could be an indication that a particular company just fell on hard times in a particular year, and as such might not be a good comp in that particular year. We have to know all this stuff, not just for our target companies, but also for the other companies in the industry. We can take that recognition and recognize it empirically with this formula that shows the present value of expected residual operating profits equals the expected residual operating profits divided by the cost of capital minus the growth rate. And we can reconfigure that to show how price to book value will vary with each of these different metrics. We have stockholders' equity, return on net operating assets, ROE, weighted average cost of capital, residual operating income, expected growth rate in ROPE, present value of expected ROPE using our cost of capital, and then lastly the value of the equity. So if we take all those numbers and we plug them into this formula here that the authors give us on slide number 20, which is the price to book equals 1 plus the present value of the expected ROPE divided by the discount using the the weighted average cost of capital divided by the equity value. All of those components are laid out here. Formulaically, when we plug them in, we can see what happens to the price to book ratio as profitability fluctuates. And this is exactly what you would expect to happen. In this instance, we are varying the return on net operating assets. As our return on net operating assets goes from 14 to 22%, you see the price to book value of company B at 1.5 and the price to book value of company A at 2.5. So the price to book value goes up significantly as the return on net operating assets increases, which is exactly what you would expect, and you'd want to pay more for a company that had higher profit margins. Now let's look at what happens when we vary the growth rate. So same formula, only this time the expected growth rate in residual profits goes from 0 to 4%. So at 0, company D has a price to book ratio of 2.2. At 4%, company C has a price to book ratio of 3.0. Okay, now let's hold everything else constant and vary operating risk. Operating risk in this scenario is, let's see, 46. Over here, the present value of expected ROPE using the weighted average cost of capital. And again, that operating risk shows up in that weighted average cost of capital. So as we vary that between low operating risk and high operating risk, we similarly see the company with low risk here, company F, has a higher price to book ratio than company E, again, all else equal. And you will rarely, if ever, see these metrics static. They are all interrelated, so it's never quite this easy to break down, but it's also important to be able to conceptualize how these ratios move together. So in this one, we're changing company leverage, which is not too dissimilar from risk levels. Company H has a price to book ratio of 4.0 versus 2.2, and there again, the leverage influences the return on equity. Let's move down to a similar deconstruction of the price to earnings ratio. Here the authors tell us that the price to earnings ratio is equal to a total of the capitalized value of current income, both normal income and residual income, plus the capitalized present value of changes in future residual income. And that's expressed formulaically here as price to earnings equals 1 plus the cost of equity divided by the cost of equity times 1 plus the present value of expected changes in residual income divided by earnings. And we can similarly break that down. And as we do so, we're going to have similar observations. Growth and risk affect price to equity in this substantially similar way that they affect price to book. Profitability really has no effect on price to earnings because earnings is in the denominator. So earnings is a derivative of profitability. So as that changes, your earnings will change, and therefore it has no effect. Unaffected by return on net operating assets, expected growth in the residual income leads to higher price to earnings ratios, higher cost of capital. Equity capital leads to lower price to equity ratios. Learning objective number 4, interpret and reverse engineer, just like we did in module number 14. Market multiples to assess the reliability of market expectations. When we reverse engineer, we take the market multiples at face value. So we know the price to earnings multiple based on the current stock market price. We know the price to book multiple based on the current stock market price. We're going to assume that's accurate and then use our formula to back into what the cost of equity, what the growth rate, what the other metrics would have to be in order to calculate that market multiple. So in this instance, we have the market value of equity, book value, ROE. We can solve for all of those. And again, this is like looking through a different lens. This is going to give us some insights into just what exactly that price that our companies are trading at in the market. It's going to tell us what other market participants think. And then we're going to be able to assess for ourselves whether or not we think a particular growth rate is reasonable, or whether or not a particular cost of equity is something that we'd be willing to accept. And if it's ballpark, then we're probably close to an accurate price. And if it's an outlier, then we'll probably have an opportunity to do a little bit more digging and discover something that's true about a stock. So let's break it down. And we're going to begin with a couple different cases here. In case number 1, we're going to solve for implied growth rates. We have the observed price to book value for 4 different scenarios or 4 different companies here. And we take that data, assume it's correct, and we have a ROE, a discount rate, and we're going to solve for the implied growth rate. So we can see here that the implied growth rate necessary to substantiate or support or validate the price to book, the observed price to book multiple, ranges from 5.4 to 2.7 to 7.6, depending on the breakdown of ROE and the discount rate that we're using. But the basic relation between those two components is that a high growth rate will substantiate a higher price to book ratio, and a lower growth rate would validate a lower price to book ratio. Okay, in scenario 2, we can solve for the implied discount rate. Same formula, just solving for a different metric. And here we have discount rates between 9 and 11.5, and you can see that those are what's required to support the 4.0 price to book. And then lastly, we can look at the solve for the implied future ROE, and if we're going to support a price to book ratio of 4.0, we're going to need an ROE of between 18 and 29. So in review, the authors give us slide 33 here, the process of fundamental analysis, models requiring, the forecasting that we did in Module 11 include the dividend discount model, discounted cash flows, residual operating income model, and then the models that I'm going to say a little bit more simple are the valuations by market multiples. So I would encourage you to do as many of these as you can for your research project, so that you're triangulating in on the most accurate measure of intrinsic value that you can possibly get at. And then just remember the basic steps for implementing these valuation multiples. You want to use forward-looking performance measures, select quality comparable companies, use both income statement and balance sheet valuation multiples, and then just be aware of the other things that are going on in the other companies to make sure that they're accurate comps. And that is the end of Module 15. So thank you for your time.